There's a secret that never gets mentioned in interviews. You won't hear it at investor conferences. You won't read it in best-selling books about building wealth. You won't find it in any financial advisor's glossy presentation. But every major investor, every family office managing generational wealth, every hedge fund that survived multiple cycles, every billionaire who didn't just get lucky once, operates by this secret. They don't talk about it. They don't teach it. But they act on it consistently, cycle after cycle, decade after decade. And here's the thing. It's not a strategy. It's not some secret asset class that only the elite can access. It's not insider information whispered in private jets and exclusive clubs. It's something more fundamental than all of that. It's a rule of the game, a rule that retail investors, the ordinary people trying to build wealth through their brokerage accounts, are never explicitly told. Not because it's illegal to tell them, but because understanding it changes everything about how you see markets, investing, and wealth itself. Let's start by demolishing some myths. These are the beliefs that most ordinary investors hold, the assumptions that financial media reinforces every single day, the conventional wisdom that keeps people running on a treadmill going nowhere. Myth number 1, find the perfect asset. The idea that wealth is built by discovering the right stock, the right investment, the one thing that's going to go up 10 times or 100 times. People spend hours researching companies, reading annual reports, watching YouTube videos about which stock is going to be the next Amazon or the next Tesla. They think the game is about selection, about being smart enough, informed enough, lucky enough to pick the winner. Myth number 2, the key is timing. Buy low, sell high. Get in before the rally, get out before the crash. If only you could predict the market's movements. If only you could time your entries and exits perfectly, you'd be rich. So people watch charts, study patterns, subscribe to newsletters that promise to tell them exactly when to buy and when to sell. They think the game is about prediction. Myth number 3, you need to know what to buy. The assumption that wealthy people are wealthy because they have better information. They know something you don't. They hear about opportunities before you do. They have access to deals, to IPOs, to investments that regular people never see. If only you had their information, you could make the same returns. Myth number 4, rich people are just smarter. They analyze better, they think faster, they understand things that ordinary people can't grasp. They're playing the same game as everyone else, they're just better at it. All of these myths share a common assumption, that markets are fundamentally fair, that everyone is playing the same game, and that success is determined by skill, information, or luck within that game. And that assumption is wrong. Not a little bit wrong, fundamentally, structurally, profoundly wrong. Here's the reality. Wealthy investors don't win by picking better stocks. They win by positioning themselves correctly within the system itself. They're not playing the same game as retail investors and playing it better. They're playing a different game entirely. A game where the rules themselves are the variable, where understanding how and when rules change is worth more than any stock pick could ever be. Let me give you the secret in one sentence. Write this down. Tattoo it on your brain. The market is not a place to make money. It's a mechanism for redistributing assets. Let me say that again because it's important. The market is not a place to make money. It's a mechanism for redistributing assets. It moves wealth from one group of people to another. And the direction of that movement, who gains and who loses, is determined not by who picked the right stocks, but by who understood the rules and who was positioned correctly when those rules changed. Or to put it even more bluntly, major investors don't make money on growth. They make money on rule changes. Now, let's get specific, because abstractions are useless without concrete understanding. How do large investors actually use this knowledge? What does it look like when you see it in practice? The first thing to understand is timing, but not the kind of timing you're thinking about. Not chart patterns and technical analysis and trying to predict whether the market will be up or down next Tuesday. Forget all that. A completely different kind of timing. Large investors position themselves before rule changes happen, not before price changes. Before rule changes, before policy shifts, before the institutional framework of the game itself transforms. They're not predicting markets. They're predicting the behavior of the people who control the markets. Think about what happened in early 2020. It's a perfect case study burned into recent memory. When COVID hit and markets crashed, the fastest bear market in history, panic everywhere, blood in the streets, the Federal Reserve responded with the most aggressive monetary policy intervention in the history of central banking. Trillions of dollars created out of thin air, interest rates slashed to zero, asset purchases on a scale that would have seemed insane just months before. The money printer went brrr, as the meme said. Now, here's the crucial question. Did ordinary retail investors anticipate that intervention? Did they understand that the Fed would effectively put a floor under asset prices? Did they know the playbook? Most didn't. They panicked, which is the natural human response to watching your portfolio collapse. They sold at the bottom. They fled to cash. They watched in disbelief and growing rage as markets recovered at historic speed despite an ongoing pandemic, despite millions of job losses, despite an economy in apparent freefall. It didn't make sense to them. It seemed like manipulation, like fraud, like the system was broken. But large investors, the institutions, the funds, the family offices, the people who do this for a living and have seen cycles before, they understood something crucial that most people missed. They understood that the rules were going to change, that the government and the central bank would intervene, had to intervene, would do whatever it takes to prevent systemic collapse, because the alternative was unthinkable. And knowing the rules were about to shift in a predictable direction, they didn't panic. They bought. They loaded up on assets precisely when everyone else was selling in terror. Not because they knew the virus would go away, not because they predicted the vaccine timeline, but because they understood that the institutional response, the rule change, would make certain assets go up regardless of what happened in the real economy. This is the pattern. It repeats over and over again in every crisis, in every cycle, throughout financial history. Large investors get in before the rule change. They position themselves to benefit from the policy response, the regulatory shift, the institutional intervention that they know is coming. And then when those rule changes are implemented and the effects become obvious to everyone, when the financial media is celebrating the recovery and retail investors are feeling confident again and starting to buy, that is when large investors start to exit. They sell to the retail buyers who are just now understanding what happened 6 months ago. They take profits while ordinary people are just getting in, convinced they finally figured it out. This isn't conspiracy theory. This isn't tinfoil hat territory. This is simply understanding how the game works. Large investors don't have crystal balls. They can't predict the future any better than you can in any mystical sense. What they have is structural understanding. They know that when crises hit, governments respond in predictable ways. They know that central banks have certain tools and will use them because that's what central banks do. They know that regulations will shift to protect certain interests because those interests have political power. And they position themselves to benefit from those predictable, almost mechanical responses. Now, what kinds of assets do large investors actually hold? Not specific stocks or tickers. That's missing the forest for the trees. The point is the characteristics of what they own, the common features that unite their portfolios across different people and different strategies. They hold things that benefit from inflation. When governments print money and prices rise, they want to own assets that rise with those prices, or faster than those prices. Real assets, commodities, real estate, productive farmland, things that are priced in the very currency that's being devalued. If dollars are worth less tomorrow, they want to own things that will cost more dollars tomorrow. They hold things that benefit from crisis. This sounds counterintuitive, almost perverse, but some assets actually become more valuable when the world gets more chaotic. Safe havens that attract panicked capital, essential services that people need regardless of economic conditions. People still need electricity and water and food no matter what the stock market does. Infrastructure that governments will protect and maintain no matter what, because society literally cannot function without it. When everyone is scrambling for safety, owners of these assets gain bargaining power. They hold things that benefit from government intervention. And this is the big one, the insight that separates sophisticated investors from everyone else. Large investors understand that when crises hit, governments don't stand by and watch. They intervene, they bail out, they stimulate, they protect. And that intervention is not random. It flows towards certain kinds of assets, certain kinds of institutions, certain kinds of interests. Large investors position themselves to be in the path of that intervention, to catch the money as it flows from the printing press to the economy. What does this look like concretely in the real world? Resources. Not just gold, though gold is part of it. Energy resources, oil, gas, uranium, agricultural land that produces food, water rights in regions where water is scarce, things that are physically limited and essential to human civilization. When money is printed and economies are stimulated and demand surges, demand for these resources increases, but their supply doesn't. You can't print oil. You can't quantitatively ease wheat into existence. Prices rise, owners benefit, infrastructure. Toll roads, ports, pipelines, power grids, telecommunications networks, data centers. These are assets that generate steady cash flows year after year, that are often protected by regulation and long-term contracts, that governments will maintain and support because society depends on them. They're also assets that typically have pricing power, the ability to raise prices over time, to pass inflation through to customers who have no choice but to pay. Control overflows. This is a subtler concept, but incredibly powerful once you understand it. Large investors seek to own not just assets, but choke points, places where value has to flow through. Payment systems that process transactions, logistics networks that move goods, distribution channels that connect producers to consumers, data pipelines that carry information. If you control a choke point, you can extract value from everything that passes through. You don't need to pick winners if you own the toll booth that all the winners have to pay to use. Scarce things, not just physically scarce like gold or beachfront property, institutionally scarce, licenses that are limited in number by regulation, permits that are hard to get and impossible to replicate, spectrum rights for telecommunications, banking charters, rights that exist because someone decided there would only be a certain number of them. In a world of infinite digital abundance where anything can be copied, artificial scarcity becomes incredibly valuable. Large investors understand this deeply and position themselves accordingly. Now let's talk about something that every retail investor has felt but few understand. Why do they consistently feel like they are unlucky? Like the market is rigged against them? Like every time they buy something, it immediately goes down? And every time they finally give up and sell something, it immediately goes up? This isn't paranoia. This isn't bad luck. There's a structural reason for this feeling, and understanding it is painful but necessary. Retail investors react to news. They see a headline on their phone, they hear about a hot stock from a friend, they watch a price spike on their app, and feel that irresistible fear of missing out. But by the time information reaches retail investors, filtered through financial media, spread through social media, discussed at dinner parties, it's already ancient history in market terms. The price already reflects whatever news just broke. The move already happened. Retail investors are, almost by definition, late to every party. They're buying after the move has happened, based on information that large investors acted on long before. Large investors act before the news. Not necessarily because they have illegal insider information, though sometimes they do, but because they understand the system well enough to anticipate what's coming. They see the conditions that lead to policy changes. They understand the incentives of policymakers and can predict how they'll respond. They know what central banks are likely to do in various scenarios because they've studied those institutions for decades. Because they have relationships with people inside those institutions, because they're part of the same social and economic ecosystem as the people making decisions. Retail investors buy good stories, a compelling narrative, an exciting technology, a charismatic CEO with a vision, a future that captures the imagination. Stories are how retail investors make decisions, how they get excited, how they convince themselves to click the buy button. And stories are exactly what large investors sell to them. When a large investor has built a position and wants to exit, they need buyers. They need liquidity. Where does that liquidity come from? From retail investors buying the story, piling in just as the smart money is quietly heading for the exits. Large investors buy influence over the rules of the game. This is the crucial difference, the gap that can never be closed by better stock picking or smarter analysis. While retail investors are trying to pick winners within the existing rules, large investors are working to shape the rules themselves. Through lobbying, through political donations, through representation on regulatory bodies, through relationships with policymakers built over decades. They don't just play the game, they participate in writing the rules. And those rules somehow always seem to favor their interests. Let me tell you the dirtiest truth about markets, the one that nobody in the financial industry wants to say out loud because it threatens the entire mythology of fair markets and equal opportunity and capitalism as a meritocracy. Markets are not designed for fairness. They are designed for managed inequality. They are mechanisms for transferring wealth upward, from many small participants to few large ones, in a way that's systematic, predictable, and perfectly legal. Liquidity is created to let large investors exit. Think about what liquidity actually means in practice. It's the ability to sell an asset quickly without crashing the price. Where does that ability come from? It comes from other people being willing to buy. When markets are liquid, when trading volumes are high, when retail participation is strong and excited and optimistic, that's precisely when large investors can sell their massive positions without moving the market against themselves. They need the crowd. They need the retail buyers to absorb their selling. Liquidity isn't created for your benefit. It's created so that large positions can be unwound onto smaller players who don't realize they're providing an exit. When panics happen, small investors panic the most. It's not a character flaw. It's structural. They have less information, less experience, fewer resources, more pressure. They sell at the worst possible time, lock in their losses permanently, flee to the safety of cash right before the bottom. Large investors have the resources, the information, the experience, and the psychological stability to do exactly the opposite. They buy the panic. They pick up quality assets at distressed prices from desperate sellers who have no choice. Every crash in history, without exception, has been a transfer of assets from weak hands to strong hands, from small investors who couldn't hold on to large investors who could. When systems are in danger, governments save the systemically important. Too big to fail isn't a bug in the system. It's a feature, and everyone at the top knows it. Large institutions understand that if they become big enough, important enough, connected enough, they will be saved when things go wrong. The government cannot let them fail because their failure would bring down too much else, would hurt too many voters, would create too much chaos. This is a form of free insurance that large players have, and small players don't. It means large players can take risks that would be insane for anyone else, knowing that if things go catastrophically wrong, the taxpayer will bail them out while they keep their bonuses. Now, here's something that seems paradoxical until you understand the game. How do large investors actually survive and thrive during crises? For most people, a crisis is a disaster. Lost jobs, lost savings, lost homes, lost dreams, lost years of progress. For large investors, a crisis is an opportunity, not despite the chaos, but because of it. A crisis is a moment of redistribution. When asset prices crash, when businesses fail, when people are forced to sell what they own, assets move from one set of hands to another. From weaker holders who can't survive the storm to stronger holders who can wait it out. From people who need cash immediately to pay their mortgage to people who have cash sitting on the sidelines waiting for exactly this moment. Every crisis in history, the Great Depression, the 2008 financial meltdown, the COVID crash, has been a massive transfer of wealth to those who were positioned correctly. They end these crises richer than they started, while ordinary people are devastated. Large investors don't really make money in good times. In bull markets, when everything is going up and everyone is a genius, everyone makes money. Your returns during good times are unremarkable. They're just market returns available to anyone with an index fund. Real fortunes, generational fortunes, the kind of wealth that changes family trees forever, are made in bad times, in chaos, in crisis. When the ability to survive, to hold, to buy when others are forced to sell, when that rare ability becomes incredibly valuable. The money isn't made in growth. The money is made in chaos. So what can an ordinary person actually take from all of this? Not fantasy, not get-rich-quick schemes, not the false promise that you can play the same game as billionaires if you just try hard enough. That's a lie, and you know it's a lie. But there is practical wisdom here about how the world actually works, wisdom that can help you protect yourself and maybe even benefit from understanding the game. First, stop trying to beat the market through stock picking. You're not going to outpick professional investors who have research teams and Bloomberg terminals and decades of experience and relationships with company management. You're not going to time the market better than algorithms that execute in microseconds based on data you will never see. The game of stock picking and market timing is designed for you to lose, to generate activity and fees, while transferring your wealth to people who understand the game better. Accept this. The goal isn't to beat the market. It's to avoid being harvested by those who can. Second, think about rules, not just assets. When you look at any investment, don't just ask, will this go up? That's the wrong question. Ask, who makes the rules that govern this asset? How might those rules change? Who benefits if they change? What would have to happen politically, economically, institutionally for this to become much more or much less valuable? The edge isn't in information about assets. It's in understanding the systems that assets exist within, the rules that determine their value. Third, watch who benefits from policy changes. When governments announce new regulations, new spending programs, new monetary policies, new trade deals, don't just read the press release and take it at face value. Ask who actually benefits from this. Follow the money. Understand that policy is never neutral, never purely technical, never just about efficiency. It always favors someone, always disadvantages someone else. Try to position yourself on the benefiting side, or at least not on the losing side. Fourth, hold some things that survive regime changes. Every few decades, the rules change dramatically. Monetary systems shift, political orders transform, empires rise and fall. What was valuable becomes worthless overnight. What was worthless becomes precious. The question isn't whether this will happen. It always happens eventually without exception. The question is whether you'll own anything that survives the transition. Real assets. Tangible things that humans have valued for thousands of years. Skills that are useful in any economy. Relationships with people you can trust. Knowledge that doesn't depend on any particular system. Things that have value regardless of what currency exists, what government is in power, what rules are in place. Here's the final truth, the cold conclusion that ties everything together. The secret that major investors know isn't about what to buy. It's not a list of stocks or sectors or asset classes that will make you rich. It's not a timing system or a strategy or a formula you can copy. The secret is understanding that the world periodically changes its rules, that the framework that governs markets, money and wealth is not permanent, not natural, not inevitable. That it shifts, sometimes slowly over decades, sometimes dramatically overnight, and that the direction of these shifts determines who wins and who loses far more than any individual investment decision ever could. The question isn't, what should I buy? The question is, when the world changes its rules, and the world always changes its rules eventually, no matter how permanent the current order seems, which side will you be on? Will you be positioned to benefit from the change? Or will you be one of the many whose wealth gets redistributed to the few who understood what was happening? That's the secret. That's what they don't tell you in investing books and financial literacy courses. That's what every major investor knows and acts on, whether they admit it publicly or not. The game isn't about being smart within the rules. The game is about understanding when and how the rules themselves will change, and making sure you're on the right side when they do.